What's up, my fellow wealth creators? Matty Ice here. So in this video, we are going to have some fun breaking down a very interesting comment that was left on one of my YouTube videos recently. And there's a lot of misleading statements in it. But fortunately, what that does is it provides us a really good opportunity to learn more. There's a lot of learning lessons that can be taken from this type of comment. It's a good opportunity to address some of the most common objections about whole life insurance, some of the most common arguments against it, and why it's just horrible. And according to this person, it's the worst. Like, dividend paying whole life insurance is the worst place to put your cash. That's absolutely a ridiculous statement. In my opinion, I would argue that it's one of the best places to store cash. And it's not just me saying this. I'm going to play a clip for you guys from a YouTube video from somebody that is way more successful than I am. So if I'm not successful enough for people to believe this kind of stuff, then you're going to hear from somebody that is wildly successful and talks about how they use whole life insurance, cash value life insurance all the time as a foundational asset. It is really powerful. It's an amazing place to save and store capital. It's been a game changer in my life anyways. We get so many more benefits from it. And then, so we're going to talk about that. And then we'll talk about we'll address some of the other aspects of the comment that like some specific parts that I think are important. But the main thing is addressing the last part of the comment where he says it's literally the worst. It's not. Now, does that mean it's right for everybody? Of course not, right? But that doesn't mean, like, just because you don't like it, that it's the worst. Give me 1 second. All right, that's a little better. I want to get a little more lighting in here. It's getting pretty cloudy outside. All right, let's read the comment first, and then let's start breaking it down. So this was a comment left on one of my videos here, the most underrated benefit of Dividend whole life insurance, in my opinion anyways, and it's the illness riders. It's often not talked about. It's kind of swept under the rug. I highly encourage you guys to go watch that video as well, because it is such a powerful benefit of whole life insurance. It is freaking awesome. But this person had something different to say about it. All right, so let's read it. Well, have some fun. There are standalone critical illness products with ROP. That's basically return of premium. Well, I'll break that down and what it is here in a minute. Also, rider on term, universal life, whole life. Also, if exercised, it permanently lowers the total benefit. Dividend paying is the most expensive insurance you can get. And I don't mean whole life. I mean specifically mutual carriers charge 8 to 15% higher than what a true whole life policy is worth, then give 5 to 6% back in a dividend. You, as a fact, do not have an estate problem. I love how he just assumes he knows what my entire financial situation is. That's pretty bold. We know you are not married or have kids. Don't really know what that has anything to do with it, but okay. For you personally, having your cash and Dividend whole life insurance is literally the worst. Very bold statements, huh? So what I really want this particular video to be about are these statements here about the 5 to 6% dividend, mutual carriers charging 8 to 15% more, Dividend whole life being the worst. But I do want to address the first part of the comment, just so you guys know what he's talking about here. These critical illness products. So basically, the underrated benefit I was talking about in this other video was that if we're diagnosed with a chronic critical terminal illness, we can accelerate a large portion of our death benefit to get the care that we want, create final experiences, memories. It's a really, maybe also protect our family from bankruptcy. One of the leading causes of bankruptcy in America is it's their medical bills. So yeah, it's just such an amazing benefit. What he's talking about here, though, is there are these particular riders on basically term policies. ROP stands for return of premium. So there's term policies out there where you can actually get all of your money, all of your premium payments back at the end of the term after the 10, 20 years, whatever. Now you're going to pay a lot. Your premium payments every month is going to be a lot more than what it would be if you did not have a return of premium policy. All right. But there are some term policies out there that usually will have a terminal illness rider. They don't usually have chronic or critical. It just depends. You got to do your research on that. All right. But he's right. I mean, there are some terminal illness riders on term products out there, universal life as well, and other whole life products. So I don't really know what the point is of that, but I guess it's good for educational purposes so that you know that these riders can be available on other products. But, for me, dividend paying whole life insurance, cash for high cash value, mutually owned life insurance company just makes more sense because we just get so many more benefits from that type of policy. Now, he is saying if you exercise these particular riders, then it permanently lowers the death benefit, the total benefit. Yeah. What's your point? So, for example, if I have a $200,000 death benefit, I get diagnosed with a chronic illness and I accelerate my death benefit. Maybe I get 100. I could accelerate 100,000 for just an example, hypothetical. Okay, I can accelerate $100,000 of my $200,000 death benefit to get the care that to get extra care for me. Okay, what that means is my total death benefit is now that would be passed on to my loved ones is now reduced by that 100,000. So I only have 100,000 left. So what though? That means that hopefully that $100,000 is going to keep me alive. I think that's more important than maintaining just a really high death benefit. If I'm able to use a portion of that to increase my odds of surviving whatever it is that I was just diagnosed with, I'm going to do that. And then hopefully we recover from it. We can buy more life insurance later on down the road. So again, just an interesting comment. But yeah, so I want to cover that really quick so you guys know what he's talking about there. Now we're going to get into whether or not dividend paying whole life insurance is the worst place to save cash. So first, I want you to hear it from somebody far more successful than me, why cash value life insurance is so freaking powerful as a foundational asset, an amazing place to save and store capital. We are not comparing it to investments. These policies can actually help our investments do that much better because we're able to, and actually what I should say is it can help us accelerate the wealth building process because we're able to do what I call asset stacking. Mark Moss here talks about building wealth in layers. It's kind of the same thing. All right, if you guys don't, I'm sure you guys, most of you know Mark Moss. If not, you should absolutely subscribe to him. He's one of the best financial YouTube channels out there. All right, but he's in this video, in this clip, he's going to talk about the foundation that he uses in his wealth building plan. It's cash value life insurance. Check it out.
But again, don't use these, use whatever, mix and match them however you want. But this is what I do. Okay, so we start number one with layer number one, which is the foundation, which is liquidity. Now, this is where most people get stuck. They don't have a system for stacking their money, right? That's actually why I built the Wealth Engine Assessment to help you see exactly how many jobs your dollars are doing and where you can optimize. Because if your money is only doing one job, right now, you're already behind. Now, if you want this wealth assessment, you can grab it for free. I'll put a link down in the description down below. Just use it, do a test. It'll show you exactly how to map this out. But
definitely recommend it. Yeah, so he calls it a wealth engine. I call it asset stacking. It's pretty much the same thing.
Let me show you how I do this. Let's start with the base layer. So for me, layer number one is life insurance. So let me just go ahead and lay that out here. Now, the first thing the wealthy do differently is they don't keep cash in a bank. Why? Because it does two things your bank never will. First, it compounds tax-free over time. Second, you can borrow against it without stopping the growth. Now, most people don't realize this, but when you put money in a bank, the bank immediately lends it out to make money off of you. Meanwhile, they pay you almost nothing. But the wealthy, of course, they flip the script and they store their cash in a properly structured life insurance policy where it earns interest and they can borrow against it. Now, let me give you an example of.
Oh man, I just love it. It's awesome. It's like what I've been saying on my channel for how long now? These things are freaking amazing, guys. When used right. So you heard it from Mark Moss right there. This is something that wealthy people do because it gives them leverage. It allows them to build wealth in multiple places at once. And with regards to saving money in a bank versus whole life. All right. So that's what this gentleman said in the comment, that having my cash in dividend whole life insurance is literally the worst. It's not. It's literally the best, in my opinion anyways. But let's just break it down logically, okay? Let's use the logical side of our brain here. If we ask yourself this, what benefits am I getting by saving money in the bank? Either a checking account, savings account, CDs, right? These are the traditional types of savings vehicles that people use, that people store their cash in. What benefit are you getting? Well, you're lucky if you're earning a little bit of interest. Historically speaking, they don't pay very much. checking, savings account, CDs, pretty low amount of interest. So you might earn a little bit of interest, which is taxed every year, by the way. And I guess the other benefit, like for a checking account, is just that you swipe it. But normally, if you're going to save money, it's going to be in some type of higher yielding savings account, CD, et cetera. It's going to be locked up for a little while. All right, that's where people typically save and store capital. But there's literally no benefit other than maybe a little bit of interest that you earn that's taxed every single year. And the bank will pay us maybe 1%, but then lend it back to us at 4, 5, 6% for the mortgage, for the car loans, et cetera. Right. So we're not getting any benefit from saving and storing our capital in the bank. The bank is getting all the benefit. They're getting rich off of our deposits. Okay. Now, what if I were to move that money that I'm saving for an emergency and opportunity, in wealth building opportunities, et cetera? I ask this question all the time. If you're going to save money, why not save it in the most efficient way possible, or the most efficient place possible? If I move it to a high cash value dividend paying whole life policy, well, now all of a sudden I go from not getting any benefits to getting lots of different benefits. My dollars are now performing multiple jobs. Mark Moss said it in that clip. Your dollar's only doing one job when you're saving money in the bank and it's earning a little bit of interest. It's not even keeping up with inflation. You could actually argue that your cash is a liability when it's in the bank because it's not working very hard for you. It's getting crushed by inflation and monetary debasement. Versus if we move it over to a whole life policy, I'm at least keeping up with inflation. These policies will typically net around 4%. After expenses. It depends on the company and the product that you go with and how you fund it and what your, what health rating you get and stuff like that. So there's different factors, but the average is right around 3.5%, 4%. Okay, well now I'm starting to keep up with inflation here a little bit, but that doesn't even include the tax advantages, right? This is something oftentimes not discussed with dividend paying whole life policies regarding the internal rate of return. Is that internal rate of return doesn't even take into consideration the tax advantages. So what would you have to earn in a taxable account to equal the true internal rate of return of a whole life policy with those tax advantages included? You might have to earn 5 or 6% in a CD to earn the same return in a whole life policy. All right. So now it's starting to get pretty attractive for a safe asset. Now we're starting to at least keep up with inflation. We get tax advantages. We can continue to get that uninterrupted compound growth and still use the money. So we can borrow against the policy. So that's the liquidity part that Mark Moss was talking about. I have liquidity. I have access to my cash value in the form of a policy loan. I'm borrowing the life insurance company's money to cover the emergency that comes up or take advantage of wealth building opportunities, put it into real estate. All right. Meanwhile, when I take that policy loan, my cash value is still getting that uninterrupted tax-free compound growth. So I'm building wealth there. And then I take that money. Let's say the life insurance company charges 6% for the policy loan. I take it and lend it out to my investor, my real estate investor, at 13% plus a point. Now I'm building wealth in two places at once, multiple layers. My policy's compounding and I'm building wealth in real estate. The only thing it costs me is that policy loan interest, which is peanuts compared to what I earn over the long run by repeating that process over and over and over again. You don't even have to do this with real estate if you don't want to. You could do it with high income ETFs. I'm going to do an entire series about asset stacking with these different assets, with real estate, high income ETFs, Bitcoin if you want. So make sure you guys subscribe. I will be coming out with that pretty soon. It's all about asset stacking and using our policies to accelerate the wealth building process by building wealth in multiple places at once. Okay. And acquiring multiple assets at once, getting our dollars to do multiple jobs. All right. But here's what about that makes whole life insurance the worst place to put cash? To me, it's just common sense. It's a no-brainer. It's like when you break it down logically and we just compare the benefits of the different places that we're normally saving and storing capital, how does it not make sense to save money in a cash value like whole life insurance policy? Now, there are some downsides, I guess you could say, where let's say I have $20,000 in a savings account and I move it over to a whole life policy. Well, I'm not going to have access to the entire $20,000 for a couple of years, right? There's that break-even point that you have to reach in a whole life policy where the amount of premium, basically the amount of money you've put into the policy, you have access to in cash value. All right, that usually takes a few years. But who cares? Like, we're not normally using all of the $20,000 in any given emergency or wealth building opportunity. You don't usually want to clean out your entire savings account. That's not good. So is it worth taking a little bit of hit in our liquidity for a long-term, what Mark Moss would call a wealth engine, a wealth machine that's going to allow us to build wealth in multiple places at once? Yeah, I'll take a hit in my liquidity all day long for that. Plus, it's not like they're just taking your money and you're not getting a benefit from it, like your money just disappears. No, you're buying life insurance, guys. So there's a cost to that. To me, that's really the only downside in the beginning, is that it takes a little while to get back to your break-even point, but it's still a phenomenal, like, I made that up in my first real estate deal, guys. When I did my first real estate loan, I made that up. Actually, it's probably my first 2 real estate deals. Anyways, that's not really the point. The point is, yeah, we take a little bit of hit in the beginning. It's worth it in the long run, though. These are long-term financial decisions that we are making. Okay. Now, I want to move on to address this other very misleading statement here. Let's reread it. He's saying dividend paying life insurance, dividend paying is the most expensive insurance you can get. I mean, specifically, mutual carriers charge 8 to 50% higher than what a true whole life policy is worth, and then give 5 to 6% back in a dividend. Let's talk about that, so that's really misleading, in my opinion, because it makes it sound like I'm paying 10% and only earning 5, for example. Like, if I had a business where I'm buying and selling products, like Walmart, for example, like, would it make sense? Like, would Walmart be in business for very long if they were buying widgets at $2, but then selling them at $1? No, they'd be out of business pretty quick. That's what this sounds like. And I don't know if that's what he's trying to say, but I could see where people would interpret it that way. Like, hey, I'm going to pay 18 to 15% more, but only get 5 to 6% back. That's not what's happening, guys. If that were the case, you would never have more cash value in your policy than what you've put into the policy. And after that break-even point, you're net positive at that point, and your policy is going to start growing by far more than what you actually put into the policy itself. So it's extremely misleading to say, just the way that he said it, I guess. Now, is it true that for the death benefit, do mutually owned life insurance companies charge more than, let's say, stock-owned life insurance companies? Is it more expensive for a participating whole life policy versus a non-participating whole life policy? Meaning, with a participating policy, you're participating in the profitability of the mutual owned life insurance company, versus if you have a non-participating whole life policy that does not pay dividends, usually from a stock-owned life insurance company, you're not participating in that profitability. The shareholders are. With a mutually owned life insurance company, you're a part owner of the company, so you participate in the profitability. All right. But do they charge more for a death benefit? Maybe sometimes. That's probably not the case in every single situation. You'd have to do your research, I guess. But again, cost is very relative here, because it's not like we're just paying these extra costs. Let's say he's right. We're not paying these extra costs and not getting any additional benefit. We're getting the benefit of being a partner with the life insurance company and receiving this dividend, which is more than just a return of premium, guys. Okay, the return of premium argument, it's an IRS, it's in the tax code. It's an IRS classification of what that dividend is, primarily a return of premium, meaning they overcharge us for the death benefit, for the life insurance. And then when they do better than what they anticipated, the life insurance company, that is, from an expenses standpoint, from death benefit claims that they've paid out, et cetera, they return that in a dividend. So the IRS classifies that as a return of premium, which gives it the tax advantages, guys. But guess what? That's not the only thing that's happening. The life insurance company takes our premiums, puts it into their general fund, which is, think of it like a very conservative corporate bond fund. All right. They're not speculating on cryptocurrencies and stock market investments. They have a little bit of stock market investments, but they're very, very, very conservative. That's why these companies have never, ever missed a dividend payment, even though they're not guaranteed. They've never missed them in over 100 years. Okay. It's because there's a lot more restrictions. They're much more conservative with where they deploy that capital. All right. So when they pay back, when they give us a dividend every year, even though it's classified from a tax perspective as a return of premium, and maybe a portion of the dividend is, there's more to it than that. Otherwise, my policy wouldn't grow. My cash value wouldn't grow. There's profitability from the general funds that's generating that, let's call it 5%, 5 to 6%. Okay. And they're divvying that back to the policyholders. So instead of shareholders getting the dividends, we get the dividends as the policyholders. Okay. So maybe they're charging a little bit more for the death benefit. Sure. That's not a guarantee that that's always happening, first off. Okay. But even if it is, we're getting so many more benefits in the form of this uninterrupted tax-free compound growth. I have high early cash value. I have liquidity immediately within the first 30 days. All right. My policy is going to continue to get that uninterrupted tax-free compound growth. I could borrow against it to invest in real estate, invest in high income ETFs, invest in Bitcoin, whatever it is that you want to do. Is it worth a little bit more cost on the death benefit? I would think so. Now here's the thing. I'm not undercutting the importance. I'm not downplaying the importance of the death benefit. We want to make sure we have a good amount of death benefit. It's literally what I was talking about in the video that this gentleman left the comment on, how important the death benefit is. However, from a wealth building perspective, and like when we design these policies, we're normally lowering the death benefit, increasing cash value so that we can use it as part of our wealth engine, as Mark Moss would call it, to implement asset stacking, to implement infinite banking, whatever. Right. The good thing is that death benefit is going to grow over time, though. Right. So it's not like we're just completely cutting out the death benefit. All right. But anyways, that's that part. I wanted to address this 8 to 15% higher cost, but then you only get 5 to 6. It's just a very misleading way to say that. In some cases, are you paying more for the death benefit? Sure. But just because you're paying more for something doesn't mean it's a scam or that it's the worst or that it's bad. The point is, are you getting something far more valuable in exchange for that additional cost? I would say absolutely 100% yes when it comes to whole life insurance with a mutually owned company. Now, what I'll wrap up with here is he says, I don't have an estate problem. I don't know how he would know that. But here's the thing. Everybody has an estate problem. If you don't have like a basic will in place, guys, please do that. I'm going to do some more videos on estate planning pretty soon, because I've just had so many conversations with people where they've lost a loved one. And I've personally seen this in my own family as well, where they don't have a will and assets get locked up in probate for years. And the family sometimes fights over it. It's just really bad. If you have a bank account, you have an estate problem. Okay. You need to have at least a will in place. I think what he's talking about, though, with regards to, since we're talking about life insurance, is that like a lot of times life insurance is used when you have a very valuable estate above like 15 million bucks or whatever the estate tax limit is right now. You use life insurance to cover taxes, et cetera. Right. That's a different conversation. I don't really know what this has to do with having life insurance or not, especially since I'm not married right now and I don't have kids. That doesn't mean I shouldn't have life insurance. That doesn't mean I don't have people in my life that I care about. That doesn't mean I don't have organizations and like charitable organizations in my life that and causes that I care about. I can provide the life insurance to whoever I want. That benefit can go to whoever is most important to me in my life, that I would want to make sure that they're taken care of, regardless of what happens to me, or, contribute a large portion of it to a very good cause as well. So you don't have to have, hang on one second, guys. Now it's getting too bright. Back this up a little bit. Yeah, we'll go ahead and wrap up with this. Like, just because, like, if you're out there listening to this right now and you don't have kids, you're not married or whatever, that doesn't mean you shouldn't have permanent life insurance, right? Because for most people at some point, they do want to get married. They do want to have kids. All right. So why not start putting that financial foundation in place now? I actually did a video about this a while ago. And I was talking about how having a really strong financial foundation in place before you get married, before you have kids, actually makes doing those things so much easier, so much less stressful, because you already have the foundation in place. Not even just from the asset stacking perspective, but also like knowing that you have this death benefit in place to protect your new spouse and new kids later on. If something were to happen to you, like already having that in place is very empowering. So you don't have to have kids and be married in order for life insurance to make sense, because there's so many other benefits to it, guys. And the last thing actually that I want to touch on that I'll wrap up with, I think this is really important, because he talks a lot about this is a very common argument against whole life insurance and why you should buy term and invest the difference, is because they're only talking about the death benefit there. Like if you're only talking about death benefit, where, this gentleman was talking about you pay 8 to 15% more for the same death benefit as a regular whole life policy. Okay. Well, if you're only talking about death benefit and that's the only thing you need, then he's right. That argument is valid, because you are going to pay more for the same death benefit within a whole life policy than you would in a term policy, for example. Okay. But it's only telling a fraction of the story. And that's the problem I have with these types of comments and arguments. It's only telling one part of the story. You're only talking about one aspect of whole life insurance. In this case, it's just the death benefit. But as you can clearly see now, hopefully from this video, we get so many more benefits from whole life insurance. So does it make sense to pay more for that death benefit? Yes. Now, that doesn't mean we shouldn't have term. I have term insurance on top of my whole life policies, guys. We want to make sure we have enough death benefit. Okay, but it shouldn't be the only part of the conversation. I'll give you an example. Buying a home, for example. If we were to take your standard 3-bedroom, 2-bathroom house, 1,500 square feet, okay, and you could rent it or buy it, which one would you do? Well, that's kind of a loaded question, because there's a lot of different factors involved other than just the living space, right? Well, it's the same thing with death benefit. There's a lot more factors involved, but let's stick on the analogy. The argument could be made that you should rent the house and invest the difference from what you would save buying the house, because it is so much more expensive to buy a house, guys. You got to save up 20% for the down payment, which is a ridiculous amount of money these days, because the average median home price has gone up like 40% in the last 10 years. All right, so you have to have the down payment. You're going to essentially pay for the house twice because of the interest on your mortgage. Okay. You've got property taxes, insurance, maintenance costs. What happens if the AC goes out, if the plumbing goes out, if you need a brand new roof? Like, you don't have to worry about all that if you just rent the house. Yet thousands of people buy homes every single day. Why? Because there are so many benefits that you can get from buying a house that you can't get from renting a house. It's the same thing with whole life insurance versus term insurance. You get so many more benefits by owning your life insurance versus renting your life insurance, which is essentially what you're doing with term. It's not, I'm not downplaying the importance of term. It has its place, absolutely. Okay. But we're talking about these arguments against whole life insurance, right? So, and here's the thing with back to buying the home. Why do people buy a home? Well, you can build equity. You can eventually sell it. There's pride of ownership as well. It's something that I own, right? It's mine. I can do what I want with it. I don't need to get permission from the landlord to, if I want to paint the walls or whatever. Okay. It's something that I could pass on to my family. I could eventually pay it off as well, right? You could pay off the mortgage and still own the asset, right? Can you pay off a lease? You could pay it up front, but if you're only ever renting, that rent is always going to be due, always, until maybe you can't afford it anymore. I don't know. Okay, but with paying off the mortgage in the house, you still own the house. The value of the house will continue to go up, hopefully over time. You could borrow against it via a home equity line of credit to purchase another income-producing asset if you want. Can you do that when you're renting? No. That's why people buy homes. And this is why people buy cash value whole life insurance, because we get all these benefits. Did you know you can also pay off a whole life policy as well, just like paying off the mortgage on your house? And it will continue to compound tax-free for the rest of your life, both the cash value and the death benefit. Yeah, you could pay into a policy for 10 years, never make another premium payment ever again, and it's going to be there for you for the rest of your life. I'm sorry. How is that the worst place to store cash? I don't understand. That doesn't make sense. And last point, using the home analogy. So the death benefit with whole life insurance is more expensive. The same amount of death benefit is more expensive than a term policy. See, not everybody's ready for a whole life policy right now. Just like not everybody's ready to purchase a home right now. So what do you do when you're not ready to buy a home yet and you're saving up for it? You rent. You have to have a place to stay. Well, same thing with life insurance. You have to have life insurance. So we rent it, buy term insurance for a certain period of time until we've saved up enough money and we're in a better, stronger financial situation, a more suitable financial situation to buy the house, to buy the whole life insurance. There's nothing wrong with getting started over here. Okay, get that convertible term life policy, lock in your insurability, and you could convert it to a whole life policy later. Same thing with renting a house. I mean, you can't really, you lose that money. You can't really do anything with it, but it's still, I think, a good analogy because you rent until you're able to buy. All right. So if you're not in a financial position to maximize the benefits of whole life insurance by funding it properly, that's okay. Lock in the insurability with a convertible term life policy. You can always convert it later on down the road. Okay. So I'm going to wrap up there, guys. We've been going for 31 minutes now, but I hope this was helpful. I think, like I said, these are really good learning opportunities, good opportunities for in-depth conversation about the different sides of these arguments, the different pros and cons, advantages and disadvantages of these different financial products. And it's only when you start to understand those things can you come to a truly informed decision about which direction makes sense for you, which financial strategy makes sense for you, which assets make sense for you, which financial products. There aren't really any good or bad financial products necessarily. Some are better than others for certain situations, for certain people. That's all, right? And you only know that when you understand how they work. So hopefully that helps, guys. I hope you're crushing it. If you have any questions, drop some comments down below. Make sure, obviously, too, you take advantage of all the additional training and free masterclasses. And I've got my first book coming out pretty soon. Maybe I'll link that down below, too, when it's available. So take advantage of all that stuff, guys. Continue your financial education journey. And I'll see you on the other side. Talk to you soon.